the question is, have we seen any problems with appraisals? And it is truly an indication of where we are in the market, because you've got your appraised value, which is looking backwards at sold comps. You've got your assessed value, which is what the county assessor is taxing you on. And then you've got your current value, which is what is the market really willing to pay right now, your market value. And actually, we're seeing the opposite. Right now, Rick, we are seeing appraisals coming in high, above what we have prices contracts for. Where we were seeing appraisals come in low was when the market was climbing so steeply, those back values just couldn't keep up. And there was so much competition that buyers were being very competitive, releasing their appraisal contingencies to land a deal, and then be serving as the comp for the next one. And it was just a series of stepping stones pushing prices up. And at this point, there's less upward pressure that we're experiencing on the market. And therefore, the market is not being as aggressive, and there's comps out there that were more aggressive. So appraisals are coming in high, at least for our lucky buyers. Any other questions? Okay, well, what the heck is going on in the market? That is really what I think you're all here and tuned in to know. And right now, layman's terms, what are we seeing going on? Sure did. Off-market sales are being considered more and more right now. Where things were really aggressive for a while, I just saw fewer sellers considering off-market offers or pre-market offers, and now sellers are a little bit more willing to entertain. If somebody's enticed and wanting to buy and motivated to buy and willing to be engaged before it hits the market, sellers are willing to play with that a little bit more. We're seeing contingent sales more. So as you saw back there, one of the sellers got a great price above asking, but what they've accepted is an offer where that buyer needs to sell their house in order to fulfill that purchase. We're seeing more of those. When you've got 350 people giving away their firstborn to buy your home, you just don't mess with that, because why would you? Releasing contingencies such as appraisal contingencies, not really happening. I think it's, in some cases, an easier thing to do if we needed to, because these appraisals are coming in some cases higher. But if you don't have to release the contingency and you don't have a motivation to, well, certainly why would you? Unless it is to get perhaps a below asking offer to look more compelling, and that might be a reason to do so. And your agent should know whether it has a very, very high chance of appraising or whether there's a little bit of risk in there. Other markets, looking around, reading some news, looking around the nation, we are hearing other markets that are just not quite as aggressive as they once thought. So that's just sort of word on the street. And then locally, we're seeing inventory growing. And so for a long time, we've talked about the years of supply and demand. Now, forgive all the complexity in this slide. Read it if you'd like. Hit me up for the details if you need them. But what this is the news on interest, and it is indeed interesting. And what we're seeing is that rates for investors are somewhere in the 5 to almost 6.5%. So dramatic that we're actually talking to more lenders, seeing who has what products, and shopping a little bit more than we would have a while ago, where everything was just so stinking compelling. You don't really always want to stray from your power team. When you've got a team who's working for you, who's doing the job, who's available, there's a time and place to shop. And when everyone's within a few bucks of each other, that's really not that time. And when you know what the best answer is, again, that's not that time. And now we're seeing a lot of things moving around. So we've got OneTrust. They've got investor and second home rates that they are doing some special things with, but then they will give you a 1-year prepaid penalty. We hadn't seen prepaid penalties in a while. And apparently 6 to 6.25 is special at this time for them. Summit Funding, Nate Pugmire, has a HELOC program that you can use for investors. You can do some sort of combining of multiple properties into one HELOC, and that's at 5.123%. And it has there's a quick payoff on it, and there's fancy things. Key Bank Their 30-year fix for owner-occupied rates, the home you buy to live in, 5.75% is what our owner-occupiers are paying. Their buying power is going which way? Down. So even if these prices go down, that buying power is following it. So it's not necessarily the thing to do to wait. If you're wanting to buy a house and you're ready to buy a house and you want a house and you're approved, I can't promise to get you more house for your buck down the road. The buck might stay the same. It's just whether it's going to interest or principal. Now, non-owner occupied for Key is somewhere near 3.4, but they do have a high net worth and jumbo loans that have some pretty special things. And so the lowest we're seeing on this screen is 4.875 for an owner occupier. If you've got high net worth or jumbo, or non-owner occupier is 5.125. So Key Bank is swooping in with some good stuff. Jumbo loans are not as hard to hit anymore, because a jumbo loan, I think, is somewhere around, the loan is around 650. So that means the loan, 850,000 purchase is only not that far from the median price of homes anymore. And then the high net worth, they include money that you would have in retirement savings toward that. And so if you can show them a bunch of money, you can get a lower rate just by having the money in the bank. So there's good stuff going on out there. If you're considering a loan, feel free to hit me up and ask me what we've vetted for a little bit more info and contacts on this, so we can help you not have to talk to 100 people, but that's what we're doing for you, is really kind of trying to follow the best products out there and see what's going on. Speaking of things that affect buying power, our property taxes. We did get the assessed values. You've seen that your assessments probably went up. Did anyone's go down? No, okay, right. But that doesn't necessarily mean your tax goes up if you want to participate in that process. The budget hearings are the way to do it. As Drost was kind enough to come here in person and tell us all about it. And the short link there is the link to where you can estimate what your taxes are going to be. It's case sensitive, and it's http://bit.ly/taxes in Idaho. No, shoot, that's a lie. 2022 taxes in Idaho. Sorry, that's a typo. So anyway, we've got a link. You can email me for that as well. Since and what you'll do is you'll look at your assessment notice, enter a few details off of that. And Drost was also running to be the assessor, Ada County assessor, but Rebecca Arnold took that position in the election, for those who are here. When you go to that tax estimator screen, and here it is with the correct link, this is what you're going to see. And so you'll plug in your county, a little bit of information, and you'll get the bad news early, instead of waiting for your notice to tell you quite exactly how much you paid. Okay, but the rental market. As investors, we need to know what's going on in the rental market as well. First Rate's got a blog, and they are now talking about giving rental market evaluations. And so if you're looking for a price, you can ask them. But here's the chatter around the First Rate property management water cooler. Showings are high and applications are high. That's a good thing. This is the prime season for renting. We like our rentals to renew in this prime season when everybody's moving. Move-in credits have become a popular tool. For the past 2 years, I have not been saying a whole lot about move-in credits. And now we're talking about move-in credits. It's almost as if there's a preemptive gearing up for making it easier for people to move in, whether it's because dollars are tight or because, but for now, market's strong. Just don't be surprised to get a recommendation for a move-in credit or some sort of tool to set your rental above the bar, above the rest.
So concessions.
Concessions. Timing is of the essence. Again, don't wait till school starts to re-rent a single family home. They're moving now. And then First Rate, Kat is the one who had this conversation with me. First Rate is expecting the market to slowly soften as July and as we get in closer to August and then into colder months. And what they're also doing to kind of help people out as rents have gone up so much in the past couple of years, how do you make it work for people? They're lowering the barriers of entry. Concessions. Also, there's an easy entry fee option, and a no application fee. And the easy entry fee, I believe it has to do with not paying a security deposit or not paying as much security deposit, but then working with the property management team to get your house move in ready, move out ready, and understanding that you are in charge of all of those expenses. So it's been a bit of an experiment, but it's engaging the tenants in the process of their own move out. And instead of getting a bill when they move out, they don't get the bill for the security deposit when they move in. They understand all of the things and are coached on how to not get a bill when they move out. And then, of course, if they get a bill when they move out, they've sort of signed on for that a little bit more, and their credit's at stake.
How many, these new apartments, how many units are becoming available with all these new huge apartment complexes?
That's a great question, and I don't know the answer, but I can come to the next meeting with that. The last time I looked into it, we were going to need to have a lot of inventory come on to really push vacancy up. And so I don't feel like we're there yet. But that'll be a good thing to look at again, because I haven't looked at that in a little while. And I'm not seeing an exorbitant, a ton of listings out there for active rentals. And here's some sample rents. Sometimes we look at NARPM data. The NARPM data is a little bit old. It came out in Q1. So instead of looking at their data, I just looked at Boise. What's going on in Boise? What are some sample rents? And I took some properties I know that First Rate's been helping re-rent. And then I also looked at Zillow to see what's actively going on there. And we're seeing $2,700 to $2,800 is what First Rate was quoting to market a brand new 4-bedroom townhome off of right by Reggie's Veggies. Over off Eustic in Milwaukee, Broadview. And 2,400 was the range, 24 to 25 for either a 2-bedroom, 2-bath, 1-car garage in the north end with shared walls, or a 3-bedroom, 1-bath, single family home. They're right in that 24, 25. 1-bedroom ranges were going anywhere from 1,200 to 1,500. And that's, and some outside of that range. 2 bedrooms were mostly 1,300 to 1,900, again, depending on your amenities and your age and your location. And then the 3-bedroom ranges, I couldn't even throw a ceiling on it, but they were, the low seems to be around 2,200. And when I look at when I show you some of the things that are available in some off markets like Wilder, it's interesting that you don't always see a drastic discrepancy in the rates of rents in Canyon versus Ada, or even Wilder versus Canyon. It's just, Wilder is Canyon. So, but Wilder versus Ada, it's not as crazy. The rents are high all across the board, not just in, say, the heart of the city. So I asked First Rate about this, this data and showing the slight uptick in vacancy, and that was Q1. So that would in theory be kind of still reflecting some earlier season data. So they don't feel like vacancy is really pushing up. But again, we talked about how there's concessions and things like that to kind of help keep vacancy down. And in the purchase and sales of duplexes, fourplexes, and then moving on to single family homes, what's going on in these purchase and sales? Well, the market trends in Ada and Canyon, and this is duplexes and fourplexes, inventory gained a little bit. Now, for the longest time, we're talking about the laws of supply and demand, and the low inventory and the high demand was really keeping things crazy. We've had slight gains in inventory from 22 to 28. And I think that was back down a little bit closer to 22 again. It's been hovering in there. And increases in inventory would indeed be a kind of leveling out of the market, a correction, which is probably long overdue, because you cannot really sustain double-digit appreciation endlessly. And pending deals dropped a little bit from 18 to 11, specifically Ada County fourplexes. We've just not seen a ton of fourplexes hitting the market lately, and those pending deals show that. And then sales down just by 1, 24 to 23. Some had been sitting for a while, so we got a couple of those closed. And then absorption has just been all over the board. And so there's just been a kind of a variable number of properties moving onto the market.
What's the time frame on these when you're comparing what inventory was to what it's now or whatever?
Yeah, this is a 1 month inventory. So this would have been the inventory for the past month. And then compared to the month before.
Okay.
So we have a 30-day turn on this. We're looking at it each month. Good question. A balanced market when it comes to absorption is 3 to 6 months. And so we still have the indications of the seller's market if you're looking at just the absorption. It's been moving around. The market's been variable. It's been a little unpredictable. We haven't had a ton of fourplex sales, like I said, but the cap rate has been pretty stable at right around 4%. Less for a newer fourplex, more for an older fourplex. It's moved around a bit, but really, if you look at that 6 month trailing, we're still at a 4% cap, around a 220 gross rent multiplier in either order, whichever way you say it. There's 2 slides. And the average price has moved around a little bit, but there's always outliers when we're looking at average prices. A 3-bedroom, 2-bath fourplex on Garverdale, that just recently sold for over $1 million. But then we've had some fourplexes showing up in other places where they're just the 2 bedrooms, the 1 bathroom, and those are 9 or less. And our days on market here show an increase, and this is a year-over-year increase, Rick. But this is skewed because we did have some fourplexes sitting on the market for a while. We had some kind of unresponsive folks out there listing them, and we had someone interested in one that was in Star, for example, and couldn't buy it for the life of us. Couldn't get the info we needed. So, but here's what's going on right now in Ada and Canyon. I think that was 7 fourplexes, maybe 8 active today on this very day. And a couple of them are, let's see, price point wise, we have a couple in the 6s. Those are going to be a very generic, very boxy fourplex on Sugar Street in Nampa. That's at $659. The Priest Place fourplexes, all of the top 3 fourplexes on these slides where the prices are below $900,000, they're all 2-bedroom, 1-bath units and not newer properties at all. Wilder, that had 2 bathrooms and that was around $900,000, and their market rents on that were $1,150 for 2 bedrooms, which I just thought was interesting. And then, and Janice was just asking about Wilder. Sorry about that, Janice. And so, yeah, I thought that was interesting. And then you get into some of the higher prices. But none of these are very new until we get to the Euclid Avenue. I can't remember what that one was.
Is that bottom one a 3-bedroom, 2-bath or something?
That one may have been, it's a larger square footage. I think it was. It had 22 days on market. So yeah, I think there were some 3 bedrooms in that one. And then when we get to 5+, what's going on in what we call the commercial? Your 5+, there's not a whole lot here that is new since last month when we looked at this. Some of these have been sitting. There is one on Catalpa, and that was 2.5 million. It was an interesting story there. The owner called Tony Drost and said, hey, I have a couple duplexes and a couple A-frames, and together they make up about 9 units. And I was wondering if you knew what the value would be. He's like, it doesn't have to happen to be on Catalpa Drive, does it? Yeah, how'd you know that? Well, yeah, Tony's familiar with the property. So yeah, anyway, that one just got listed 2.5, and yeah, that's what we're seeing for the pricing for what's available right now. We've sold, as we've discussed, we've sold a lot of single family home properties to investors lately, because once those cap rates, if you're getting almost the same cap rate for a single family home, and it's a newer single family home, well, there's some ease to that. And so we've looked at a lot of that this year, but these homes, as you see, our median price of homes is up to $602,000 in Ada County. That's the median price of homes. Now, what's interesting is while that's higher than it's been, that's only a little jump from the $595 median price of homes I announced last month. New construction really pushes that number up. And so some of that is a boost from new construction. And the inventory gets a wow. It's up a lot from last month in Ada County. So the median price only up a little, but there's an indicator right there. When you start getting a lot more inventory, that's a supply and demand thing there. So again, some of that inventory is going to be new builds not flying off the shelf as quickly. But yeah, 167% increase from last year over year on that 1,500. That's
What I've noticed in Phoenix, involved in that area lately, is I've seen a couple of different developments that are new, building single family homes. They're building them building for investors for rentals, the whole development for single family homes, which is kind of interesting.
It is. Yeah, and there's an entity out here that does that as well. Their LLC is based out of Eagle, and we have a house under contract where we had to kind of go look at that because it's right next to one of those communities. Now, what's interesting about those communities where they're buying them through REITs, et cetera, and they're all single family homes. So they're putting a bunch of REIT money together and building a whole single family home community. They're giving them a swimming pool, some amenities, but they're also including yard care, front and back, and snow removal. And so if you happen to have one of these in your backyard or next door to you, I think that's not as, I don't know if threatening would be the word, but I just don't think you're going to notice that it's a rental community. You might notice more entry level finishes compared to the higher end community next door. But because the lawn care and the landscape and the snow removal are some of the first indicators of rental that kind of make you go, what's going on? And they do have CC&Rs, and there's probably parking restrictions. So the only other way you might be able to pick a rental out of the crowd is it would just be depending on what sort of window treatments they included. But these folks they understand how to do rentals. They're on the same page. They're putting money into these properties. So I bet they're including blinds. So you're not gonna, see somebody who's not in the blinds buying phase of life living there and hanging up tapestries in the windows or something. So you won't necessarily know it's a rental community.
I think they're also managing them often.
They are. One of them's American Home something out here that we've seen. Yeah. They're managing them, and they're managing them probably well to take care of them. And that's important, so hopefully they're not letting that maintenance defer, because that's going to cost their investors money in the long run. Canyon County, our median price of homes is actually lower than it was reported last month. So we maybe saw threats of that. December was kind of quiet. We maybe saw, I don't even think it actually went down. I think it maybe stabilized for a month over winter there. But yeah, no, we actually saw the median lower than it was last month, but that's still 12.6% higher than it was last year at this time. So when we look at the market and as buyers, you're like, okay, where are the deals? And the sellers are like, hey, it's still a hot market. We're not seeing prices necessarily that much lower than they were a month ago. I'm not like, oh, we're back to October pricing. Prices are still in general higher than they were then. Negotiating power is higher. They're not rising as steeply. And we are seeing comps that are higher for some homes, but that doesn't, I haven't felt like decreases, but we do have some indicators saying that, hey, maybe that's going to happen, because buyers are reading the news, they're hearing this, and they're just not going to be as aggressive on their offers. So that could put, and as inventory comes on, that will put downward pressure on things. So that's our market update. Any questions? Did I answer your questions that you probably came in here thinking what's going on in the market? Probably also a little bit of what you expected to hear as well.
Yep.
Okay.